Good morning. It is Wednesday, March 1st, 2023. And I'm going to get started in a moment on Chapter 5 in Accounting 110. And the subject matter this week is adjusting journal entries. And they take a little bit of thinking, but I'm going to go over them, I think, in pretty good fashion here. And we have a visitor. Pray tell, who could this be? Ali is trying to join us. Hi, Ali.
Hello.
Hey, good. Came in at a real good time. We're just getting started, okay?
Perfect. Okay, thank you.
And we're up to Chapter 5, adjusting journal entries, huh? Did you take the first exam, Ali?
I did.
How'd you do, okay?
I did pretty good.
All right, that's what we want to hear. I had a feeling you did. Now, the $100 question, Ali, you must answer before we start. Do you see the slides?
I do.
Okay. All right, no blank slate this time, huh? Okay, adjusting journal entries, adjusting entries in the worksheet. When the trial balance is prepared at the end of the month, okay? The month is ended, we've recorded all of the transactions we know about. We recorded all the sales, all the purchases, all the expenses, the revenues, everything. That trial balance, unfortunately, by definition, is incomplete and needs to be adjusted. Up until this chapter, we've been assuming that the trial balance is perfect so that you guys can learn how to prepare the financial statements and do the trial balance and other things. But we're going to have to do what are called adjusting entries. We have to consider equipment wearing out in the form of depreciation expense. Here's a word you've not seen, I don't think, too much: prepaid insurance and prepaid supplies. Those are items that we purchased. When we purchased them, they were an asset because we haven't used them yet. Now at the end of the month, we have to consider how much of that we used. Employees earning wages that have not been paid. Yeah, you've all pretty much been out in the workforce. When you get your last day of work on Friday and go home, you don't get paid that Friday for that day. You're going to have to wait a week or two for your payroll. When that overlaps the month, it requires an adjusting journal entry, okay? And the whole purpose of the adjusting journal entries is to comply with the matching principle. And that tells us that revenues must match expenses. Revenues match expenses. Oops, come on now, what's wrong with you? Revenue recognition principle. This we should know already, huh? Revenues recognized when they are earned, when they take place, regardless of when the cash is received. If I sell you something today and you're not supposed to pay me for 2 months, today is when I record that sale. I earn that sale today. Revenues are considered earned when a service is provided or you move the product. Same thing with expenses. They are recognized when incurred, regardless of if there's any cash involved. Expenses are generally considered incurred when the goods are received or assets are consumed. And here's the matching principle, which I guarantee will be on the test and at least in one multiple choice question. Matching principle: you match revenues and expenses. It provides the best measure of net income. And to follow these principles necessitates that accounts be brought up to date before the financial statements are prepared, okay? The month is ended, we ran the trial balance, and good gosh, it's incomplete. And we have to spend a day or two adjusting it. We know what a fiscal year is, any 12-month period used as the accounting period. It does not have to be a calendar year. And some businesses schedule their fiscal year to end when business is slow. I was interested to read about Nordstrom and major retailers. Their year end is like February when things are a little bit slower, and they want to capitalize on the busy shopping season they had in December and get those statements out. Generally, adjustments are made and financial statements are prepared at the end of a fiscal month, not a year. For purposes of our book, they keep saying a year, but no, companies do this every month. Here we go. Let's look at our first adjustment, Ali, okay? Adjustment for supplies. Mitch purchased $80 worth of supplies. Okay, that's a debit to supplies and a credit to cash, perhaps. It doesn't tell us. That $80 is in an asset account called supplies. Not too hard. Now it's the end of the month. The end of the month. According to an inventory of supplies, there are only $20 worth of supplies on hand. In the middle of the month, maybe we bought $80, and that goes into the asset. Now it's the end of the month. There's only $20 left. Therefore, we used $60 worth of supplies that need to be recognized as an expense. Unless an adjusting entry is made, $80 of supplies would be shown on the balance sheet, which is wrong. Assets would be overstated. Supplies expense would be understated. You'd be reporting too much income. So we have to prepare a journal entry, and that entry is to debit the supplies expense, credit the supplies, huh? And here they're showing it to you. Let me make it a little bit bigger for me, if not for you. So take a look at this, Ellie. We had 80 in supplies when we ran the trial balance at the end of the month. Now we know we only have 20. So we have to get rid of $60 worth of this asset and record it as an expense. We debit supplies expense and we credit prepaid supplies, the asset, okay? Same thing with insurance. When you buy an insurance policy, by definition, it is an asset. It's an asset because you haven't used it yet. You haven't got the benefit of it yet. For example, you buy a casualty insurance policy on December 31st to cover you in the following year. Well, you don't have insurance on December 31st. The policy doesn't kick in until the 1st. If your factory sadly had a fire or something, you have no insurance. January 1st, you do, and that is when you start recording an expense. So Mitch bought an insurance policy for $700. This is supposed to be $700 up here, I think. He bought a $700 for a 10-month policy. So what did he do? He debited the asset called prepaid insurance, and he credited cash. Now he says to himself, well, 1/10 of that 700 I earned in this current month. June is over. We need to remove the cost of that insurance from the prepaid. So we're going to debit prepaid expense for 70, credit prepaid insurance. Okay. Another way to look at these types of adjustments, we're taking this asset and we're expensing it over time by the month. We're going to make this same entry for the next 6 months until we're next 9 months, whatever, until we get rid of that $700 in the asset.
Okay.
And here it is here. We'll take another peek at it. Prepaid insurance. We ran the trial balance. $700 was there. We know that it comes out at the rate of $70 a month. It was a 10-month policy that kicks in June. So we are going to debit the expense called insurance expense and credit the asset prepaid expense, okay? Now, here's one that you'll be familiar with. You guys have been out in the working world, I know. Unpaid wages adjustment, accrued wages, we call them, okay? Rohan paid his part-time employees $1,650 on June 27th. This is supposed to be $1,650, but all right. He paid his part-time employees $1,650 on June 27th. He paid them. Since then, though, they earned an additional $400. In other words, on June 28th, 29th, and 30th, his employees have worked and earned an additional $400. But that money's not going to be paid. You're not going to get paid for that until next week or even in 2 weeks. So that $400 was worked during June, not going to be paid until July. So we have to take this $400 and we are going to put it into wages expense and credit wages payable. It's a liability. It's a legal liability. If you quit your job on that day, you'd be entitled to your pay immediately. If the company let you go or the company went out of business, they would owe you that money as of the 30th. So it is a legitimate liability, and we recognize the expense. So let's take a peek at the expense. Remember, Rohan had already processed $1,650, right? That's the payroll through the 27th. We're done with that. That's paid and gone, huh? The 400 were the hours earned during the last few days of June. We debit wages expense, credit wages payable. Debit wages expense, credit wages payable, okay? Okay, let's talk about this. The historical cost principle. Everything on the balance sheet, every asset is recorded at the actual cost. And that cost remains on the general ledger as long as the business owns the asset. No adjustments are made for changes in the market value of the asset. In other words, you buy a machine for $10,000. And after a couple of years, it turns out that that machine is a popular collector item for people. And you realize you can sell that machine for not 10,000, but for 100,000. You cannot record that gain at that time. You can never record a gain until you actually make the sale. But if the cost goes down, if it turns out that machine stinks, it doesn't do the job, you have no benefit from it, then you do have to recognize the loss. You always anticipate and record losses, and you never anticipate and record gains. That's a accounting principle. Historical cost, everything is on your balance sheet at the actual cost. So we're going to talk now about fixed assets, big machines, cars, forklifts, buildings, things like that. These assets have what are called a useful life, period of time that an asset is expected to help produce revenues. In other words, how long is this asset going to last? If it was a car, maybe we'd say that the useful life is 5 years or something. An asset's useful life expires because of wear and tear. It no longer works the way the business wants it to. Expenses should be recognized and the value of the asset should be reduced over the useful life. And we're going to do that, Ellie, with something called depreciation expense, huh? Depreciation expense, a method of matching an asset's original cost against the expenses produced over the useful life. There are numerous methods which you will learn in this class, I believe. We're going to start with just the simplest one and the most popular one used by businesses in America, straight line. Depreciation expense is based on estimates of useful lives, and we have to consider what's called salvage value. The expected market value at the end of the useful life. In other words, Ali, we bought our sales manager, we bought her a big old SUV for like $100,000, and she uses that car to drive up and down the coast, schlepping product around and samples. We may say, well, that car cost us $100,000, and it's only going to last us 5 years due to the amount of driving done. But we also say to ourselves, that car, even after it's done working for us, still has some value. Maybe it's only $1,000. We call that the salvage value, the residual value. It just means how much someone will give us to take that machine away from us. We figure, well, a scrap dealer will always come in and grab an old car for parts, okay? $1,000. Depreciable cost is the cost of the asset less salvage value. Let's skip that for just a second. Here's your first look at the adjusting journal entry called straight line depreciation expense. Mitch bought scooters, $4,800, and they have a useful life of 5 years. Mitch can deliver pizzas for the next 5 years, okay? Salvage value is 0. That makes it a little bit easier. We don't have to worry about the salvage value. That just means we're going to depreciate the entire $4,800 over the next 5 years or 60 months. Assume that a full month's depreciation is recognized. How do we calculate it? We're going to go and take 60 months, 5 years times 12 months, and we're going to divide that into the original cost of the asset. This asset cost Mitch $4,800. It's going to last him 60 months or 5 years, 60 months. Therefore, the depreciation expense every month is $80. For the next 59 months, Mitch is going to write the same journal entry. He is going to debit depreciation expense, and he's going to credit an account called accumulated depreciation. So let's take a look at this. The depreciation expense was $80, we decided. You debit the expense, $80. Notice, though, you do not reduce the delivery equipment. Remember what we said. Our assets are always at the historical cost. You will never credit that $4,800. That'll stay there forever, unless you sell it. Okay? What you do credit, though, is a contra account called accumulated depreciation. So get used to accumulated depreciation. It is a contra asset account. Contra meaning it has the opposite sign control. When you credit accumulated depreciation, you are increasing it. What's being reduced, Elio, is the difference between these two numbers, which is called the net book value. And that's what people want to look at. So let me go back and go over that. Book value, huh? The value carried on the books in the accounting record. Book value, original cost of the plant asset, which in this case was $4,800, minus $80 for accumulated depreciation. That gives you a net book value of $4,720. Next month, it would go down to $4,640, etc. Until after 60 months, the expense has been totaled up to $4,800 spread over 5 years, and the net book value of the asset is 0. That means the asset is fully depreciated. Book value, it's the undepreciated amount. And keep in mind, it has nothing to do with the market value or selling price of the asset, as I told you in that example. Let's understand accumulated depreciation, contra asset account. Contra means opposite. It has a credit balance. It goes up with a credit. It's deducted from the asset account to get the net book value. Now, depreciation expense is a pretty easy one because it's always the same. It's always a debit to depreciation expense. Depreciation meaning wear and tear. The product is less in value every month, and we're allowed to estimate that amount. Debit depreciation expense and credit accumulated depreciation. And here was the journal entry, okay? And they're just showing us an expanded chart of accounts. In this chapter here, we picked up some new things, didn't we? Accumulated depreciation, delivery equipment. You notice over here, Ellie, you got the assets. They all begin with 1, which is very normal. 101, 102. Notice, though, when you get to accumulated depreciation, they put a dot 185.1. That typically means that it's a contra account. That's all. We picked up wages payable just now. That's going to be an adjusting entry every month. And we're going to have adjusting entries for supplies, insurance expense, depreciation, among a few others, okay? And now we post the entries to the ledger, and we know how to do this, huh? We are experts. Here, we're posting the, excuse me, we're posting the adjusting entry as follows. We're debiting supplies expense, and there's the posting of it right there. We posted a ledger, and now the balance is $60. It was 0 before. And they're just showing you the various postings, and I think we know this already. Here they're just showing you 2 journal entries here. You debit supplies expense. Supplies expense comes over as a debit, and a credit comes over to the asset, prepaid supplies. Ditto with the insurance. The insurance, we debited it for 70. Here, we're posting it. We hit the post button, and now it moved it from here to here. And same thing with the prepaid insurance. That asset is now $630 as a result of the adjusting entry, okay? As a result of the adjusting entry. And they're just showing you the other 2 we looked at. Wages payable, wages expense. We debited wages expense, and look at that. It gets layered in right on top of that $1,650 payroll that had already been processed and paid. And that gets the total payroll expense for the month to $2,050. And here's your depreciation expense. Companies love depreciation expense because it is an expense that doesn't require any cash. There's no cash involved. It's just an estimate of wear and tear. So companies love depreciation expense because it lowers your net income without any cash involved. So if you have, say, $100,000 worth of depreciation expense, you just lowered your net income by $100,000, but there was no cash involved. So you get a tax benefit of the 30%, whatever it is, $30,000, $35,000. Okay, now we've learned how to get going on adjusting entries. And they'll be a little bit tricky as you do your homework, but shouldn't be too bad. What we're going to learn now is that we can prepare a worksheet from the adjusted trial balance. And from that adjusted trial balance, we can prepare the financial statements like we've been doing in the first 4 chapters, okay? Prepare a worksheet. Well, what's on a worksheet? It's going to pull together all the information we need to enter the adjusting entries and prepare the statements. The worksheet is just scrap paper. It's not a financial statement, and typically an Excel spreadsheet of some kind, not a formal part of the accounting system. And the only people interested in a worksheet are the accounting people. And typically, we're going to talk about a 10-column format. So let's see here. 5 steps, preparing the worksheet. Step 1 is where we left off at chapter 4. We know how to prepare the trial balance. Now, in this chapter, we have to prepare the adjustments and then prepare the adjusted trial balance, And then from that, we can do the income statement and balance sheet. So let's see what we've got going here. The worksheet, again, this is just a piece of scrap paper. It's an Excel file. You can put the heading on it as you like. Step 1, prepare the trial balance. This is the same trial balance from chapter 3, now being shown on a worksheet. Prepare the trial balance. We know how to do a trial balance, I hope. Prepare the adjustments. You're going to have 2 columns after the first 2 columns for the trial balance. Record the adjustment. Make sure each adjustment's on the right line. Identify each entry by a letter. That helps keep track. And you rule the adjustment columns, total the debit and credit columns, etc. So let's see what we're talking about, okay? Ta-da! Here is your 10-column worksheet. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And Ali, I'll give you a tip on the test. For God knows what reason, they always like to ask what the columns numbers are. In other words, they'll say, true or false, the adjustment column is in 5 and 6, so it would be false. 1 and 2 is the trial balance. Then the adjustments, then we're going to add these numbers together to get the adjusted trial balance. And from that, we can pull the income statement and the balance sheet. 5 steps. Trial balance, we've already done that. Adjusting entries, then we do the new trial balance and prepare the income statement and balance sheet in that sequence, okay? So let's look at our adjusting journal entries here, Well, let's start with, go from top to bottom. Supplies, We used $60 worth of supplies. We had 80, we used 60. That means we're going to have to put 20 on here on the adjustment line, on the adjusted balance line. Insurance was 700. Now we use 70. Here is our accumulated depreciation. Apparently there's none because this was the first month of business and you didn't have anything before that. And here's our credit to wages payable, 400, the debit to wages expense. Here is our $60 and $70 coming over for prepaid supplies and prepaid insurance. And when you credit accumulated depreciation, you always debit depreciation expense. No exceptions to that one. Okay, now we're ready to prepare the adjusted trial balance. Ali, we had a beginning balance and we had a second pair of columns. We put the adjusting entries. Prepare the adjusted trial balance. Extend those debits and credits that are not adjusted directly to the adjusted trial balance column. If an account has a debit and a credit, you subtract. If it has 2 debits, you just add. It's just a matter of debiting and crediting with the rules we've learned. And then they're talking about double lines and stuff. I'm not worried about that. And of course, guess what? Debits must equal credits, Who knew? So here we go. Wow, look at the size of this worksheet. It's getting big, But it's not tremendously difficult. It's just logical. You're starting with the trial balance at the end of the month, knowing that we have to do some adjusting journal entries. And we list those adjusting journal entries in the second pair of columns called adjustments. And now look what we do. We go through each line and adjust as needed. Cash, 470. Well, you never have an adjusting entry for cash. Cash is not like supplies. You don't send somebody out to the safe and they tell you, There's only $1,000 out there where you're supposed to have 2,000. That doesn't work that way. Same thing with receivables. So a lot of these accounts you will never adjust. But look at the supplies. The supplies were 80. We used 60. We're down to 20. Prepaid insurance was 700. We used 70. We subtract out, we get 6,300. The delivery equipment, $4,800 is not going to change. What's going to change is the net book value. In this case, we have, that's distracting. In this case, we have $80 in accumulated depreciation. Ali, if you're there?
Yes, I'm here.
Yeah, if we, for some reason, this thing wants to knock us out. If it knocks us out, let's go right back in, okay?
Okay.
So I'll try to let it get, what's the word I'm saying? Segue properly, okay? Anyway, now we add the adjusted trial balance, and we've got it right here. So now all we need to do is do the income statement and the balance sheet. The income statement and the balance sheet. Take a look at this, Ellie. Here's the whole worksheet. That wasn't too bad. We did the adjusted trial balance. At this point, we could draw a horizontal line above the delivery fees. Everything above the delivery fees is your balance sheet. Everything below is your income statement, okay? They talk about methods for finding errors. Let's not spend any real time on that. And you journalize the adjusting entries from the worksheet. We understand that. We just looked at those journal entries. Here are those journal entries. We saw that already. We're not going to talk about cash system at all. We are strictly accrual. Revenues are recorded when earned. Expenses recorded when incurred, huh? Don't worry about cash basis, modified cash, baloney. Actually, that takes us to the end of the lecture, huh? We zipped through those last few because we're not going to be covering them, okay?
Okay.
Have any questions, Ali? Does it seem overwhelming or something you can handle a little bit?
No, it seems like it's doable.
Oh, yeah, it's certainly doable. Just don't look at that big 10-column worksheet and go, oh, goodness gracious. Very logical, right? Okay. Do you want to call an end to the meeting, Ali?
Yeah, we're done.
Okay, we'll see you next week, okay?
See ya. Bye.
Bye-bye.